You know what keeps me up at night? It's not competition from Walmart or regulatory hearings in Washington. It's watching millions of people make the same catastrophic investment mistake I almost made back in 1999, right before the dot-com crash. Last month, I watched a documentary about silver investors who lost everything during the Hunt brothers collapse in 1980. These weren't stupid people. They were doctors, engineers, successful business owners who genuinely believed they were protecting their wealth. And then, in a matter of weeks, they were wiped out, completely destroyed financially. And here's what terrifies me. We're watching the exact same pattern play out right now in 2025, except this time it's worse because social media has weaponized the misinformation. I need to tell you something that's going to make a lot of people angry. Silver is not the safe haven investment that YouTube gurus and podcasters are selling you. It's a speculation dressed up as wisdom, and the people pushing it hardest are the ones profiting from your fear. I learned this lesson the hard way, and it cost me $7.3 million in a single afternoon. Let me explain exactly what happened, because the story starts in a place you wouldn't expect. My garage in Seattle, 1994. I was packing books into boxes, building what would become Amazon, and my father came to visit. He sat down on a folding chair I'd bought from Costco for $12 and watched me work for about 20 minutes without saying anything. Then he said something I'll never forget. "Jeff, your mother and I believe in you, but we're putting our retirement money into gold and silver because when your internet thing doesn't work out, at least we'll have something real." That word, real, it haunted me for years. Because here's what I discovered. The concept of real value is one of the most dangerous illusions in investing. My parents didn't invest in precious metals back then, thank God. But that conversation planted a seed in my mind. What makes something valuable? Is it because you can hold it in your hand? Is it because civilizations have used it for thousands of years? Or is value created by something entirely different, something most people fundamentally misunderstand? Fast forward to March 2000, and I'm worth about $10 billion on paper after Amazon's stock has gone absolutely vertical. And I'm terrified. The NASDAQ is starting to crack. I can see the dot-com bubble deflating in real time. And I get a call from a wealth manager at Goldman Sachs who tells me I should diversify into hard assets. Gold, silver, real estate, commodities. The pitch was seductive. While tech stocks are crashing, precious metals will hold their value. It's been true for 5,000 years. Silver is undervalued compared to gold. The gold to silver ratio is out of historical norms. This is your chance to preserve wealth while everyone else is panicking. I almost did it. I came within 48 hours of moving $7.3 million into silver futures and physical silver. Then I did something that saved me. I asked myself a question I ask about every business decision at Amazon. What problem does this solve for the customer? And suddenly, the whole precious metals pitch fell apart because silver doesn't solve any problem. It sits there. It doesn't generate cash flow. It doesn't innovate. It doesn't create value for customers. It just sits there, shiny and inert, while you hope someone else will pay you more for it later. That's not investing. That's speculation based on fear. Here's what nobody tells you about silver. And I mean nobody in the precious metals industry, because their entire business model depends on you not understanding this. Silver has had negative real returns over almost any long-term holding period you can measure. From 1980 to today, 45 years, silver has returned approximately 0% after adjusting for inflation. 0. Meanwhile, the S&P 500 has returned over 2,000%. A dollar invested in silver in 1980 would be worth about $1 today in real terms. That same dollar invested in a basic index fund would be worth over $20. This isn't a close call. It's a massacre. But Jeff, you might be thinking, what about inflation? What about the collapse of fiat currency? What about the fact that governments can print unlimited money? These are the arguments I hear constantly, and I need to address them directly because they sound sophisticated, but they're based on a fundamental misunderstanding of how value is created in a modern economy. Let me tell you about a meeting I had in 2007 with a very smart hedge fund manager. This guy ran $15 billion and had an incredible track record. We're having dinner in New York, and he's explaining his thesis on precious metals. He says, Jeff, money printing is going to destroy the dollar. The only way to preserve wealth is to own things that can't be printed. Gold, silver, farmland, commodities. The government can create infinite dollars, but they can't create infinite silver. I listened to his whole pitch, and then I asked him a simple question. If you're so convinced the dollar will collapse, why are you measuring your returns in dollars? He looked at me like I'd asked him why water is wet. I said, think about it. You're betting against the dollar by buying silver, but you're measuring success by how many dollars you can sell that silver for later. You're contradicting your own thesis. If the dollar truly collapses, your silver won't make you wealthy. Nothing will matter because society will have broken down completely. And if the dollar doesn't collapse, you've just spent years earning zero return while inflation and opportunity costs destroyed your wealth. He didn't have a good answer. 6 months later, his fund was down 38% because he'd levered up on commodity bets right before the 2008 crash. He's not managing money anymore. This is what I mean when I say silver investing is based on fear rather than rational analysis. The entire pitch requires you to believe simultaneously that society will collapse enough that dollars become worthless, but not collapse so much that silver becomes worthless too. It's incoherent. In a real collapse scenario, you know what's valuable? Food, water, shelter, energy, medical supplies, skills, community. Silver bars sitting in a vault don't help you survive. They're just heavy. Now, I can already hear the pushback, but silver has industrial uses. It's used in solar panels, electronics, medical equipment. Demand is going to skyrocket. This is a better argument, but it's still wrong for individual investors. Here's why. If silver demand increases because of industrial use, that's a business opportunity for mining companies and industrial suppliers. It's not a reason for you to buy physical silver or silver ETFs. You know what I did when I identified the massive growth opportunity in cloud computing? I didn't buy computer chips. I built Amazon Web Services. I created a business that generates $60 billion in revenue and operates at 24% margins. That's how you capitalize on a trend. You build something that creates value for customers. Buying silver because solar panels need silver is like buying iron ore because buildings need steel. The real money isn't in owning the commodity. It's in building the business that transforms the commodity into something customers actually want. When I look at silver investors, I see people who have correctly identified that they're worried about the economy, about inflation, about instability, but they've chosen the worst possible solution to that problem. They're hiding instead of building. They're hoarding instead of creating. And that breaks my heart because these are often smart, hardworking people who deserve better advice than what they're getting from the precious metals industry. Let me give you some numbers that nobody in the silver industry wants you to see. The average silver mining company has returned negative 12% annually over the last 20 years. Negative. These are businesses that literally pull silver out of the ground and sell it, and they can't make money doing it. Why? Because silver prices are volatile, mining costs are high, and there's no pricing power. If professional mining companies with geologists and engineers and decades of experience can't make money on silver, what makes you think you will? You're competing against industrial users who need silver for manufacturing, against traders with sophisticated algorithms, against mining companies with inside information. You're bringing a knife to a gunfight. Here's something that happened to me in 2011 that crystallized all of this. Silver had run from about $18 an ounce in late 2010 to $48 in April 2011. People were going absolutely crazy. I was getting emails from friends, from Amazon employees, from people I hadn't talked to in years, all asking me if they should buy silver. The fervor reminded me of the dot-com bubble, except worse, because at least internet companies were building something Silver was just sitting there getting more expensive because people thought it would get more expensive. Classic bubble psychology. I wrote an internal memo at Amazon that I've never shared publicly until now. I wrote, "The silver bubble is a perfect example of what happens when fear replaces analysis." People are buying an asset with no cash flow, no competitive advantage, no customer value proposition, purely because they're afraid of what they don't understand. This will end badly for almost everyone involved. 6 weeks later, silver crashed from $48 to $26, a 45% crash in 8 weeks. Millions of people lost billions of dollars, and here's the worst part. The people who got hurt the most weren't Wall Street traders who could afford the loss. They were regular people who'd converted their retirement savings into silver at the peak, convinced they were protecting their families. I want to tell you about someone specific because this is where theory meets tragedy. In 2012, I got a letter from a man named Richard. He was 62 years old, a mechanical engineer who'd worked for Boeing for 37 years. He'd saved diligently, lived below his means, built up a retirement account worth about $900,000. In March 2011, he went to a precious metals investment seminar. The speaker showed charts of silver prices going back hundreds of years. He talked about quantitative easing and money printing and the inevitable collapse of fiat currency. He made it sound so logical, so safe. Richard converted his entire retirement account into physical silver at an average price of $42 per ounce. By the time Richard wrote to me, silver was at $28 per ounce. He'd lost about 33% of his retirement savings, about $300,000. But here's what made it worse. He couldn't bring himself to sell because he'd been taught that selling silver was giving up on sound money principles. He was still holding, still believing, still waiting for silver to return to $42. As of today, December 2025, silver is at around $31 per ounce. Richard waited 14 years and still hasn't broken even. Adjusted for inflation, he's lost over 50% of his purchasing power. His retirement is essentially destroyed, and he's 76 years old with no way to earn it back. This is not a hypothetical. This happens to real people every single day, and it makes me furious because it's preventable. The information is available. The historical data is clear. But the precious metals industry has created an ecosystem of fear-based marketing that preys on people's legitimate worries about the economy and redirects them toward a solution that doesn't work. Let me explain the business model, because once you see it, you can't unsee it. Precious metals dealers make money in 3 ways. First, they charge a premium over spot price when you buy. This premium can range from 5% to 30% depending on the product. You're underwater the moment you purchase. Second, they charge a discount to spot price when you sell back to them. So you buy at spot plus 10% and sell at spot minus 5%. You need silver to increase 15% just to break even. Third, if you store your silver with them, they charge storage fees, annual fees that compound over time. Now, here's where it gets really interesting. The people selling silver are often the same people creating content about why you should buy silver. They sponsor YouTube channels, podcasts, newsletters, all pushing the same message. The dollar is collapsing. Silver is safe. Buy now before it's too late. This isn't financial advice. It's marketing designed to generate commission revenue. And it works incredibly well because it taps into primal fears about security and uncertainty. I saw this exact same pattern with cryptocurrency advocates in 2017 and 2018. The true believers weren't just invested in Bitcoin. They needed you to invest in Bitcoin because that's what would drive the price up. It's a recruitment model disguised as investment advice. The same thing happens with silver, except the silver industry has been perfecting their pitch for 50 years. They've got it down to a science. Let me contrast this with how I think about investing. When I look at a potential investment, I ask 7 questions. First, does this generate cash flow? If not, how will I make money? Only if someone pays me more later, which is speculation, not investing. Second, does this create value for customers? Silver creates value for industrial users, but not for individual investors. Third, what's my competitive advantage in this investment? Do I know something other market participants don't? With silver, the answer is no. Professional traders and industrial users know far more than I do. Fourth, what's the opportunity cost? What am I not buying because I bought this? If I buy silver, I'm not buying businesses that innovate and grow. Fifth, how does this perform in different scenarios? Silver is supposed to hedge against inflation, but the data doesn't support that. Sixth, can I hold this for 10 years without checking the price? If not, it's probably speculation. And seventh, would I be comfortable explaining this investment to my children as a smart use of capital? When I apply these 7 questions to silver, it fails almost every one. It generates no cash flow. It creates no customer value for me as an individual investor. I have no competitive advantage. The opportunity cost is enormous because I'm giving up returns from productive assets. It doesn't consistently hedge inflation. I'd be constantly checking prices because there's no underlying business to anchor value. And I'd be embarrassed to tell my kids I bought silver hoping someone would pay me more for it later without any fundamental value creation in between. Now, let me address the elephant in the room. Jeff, you're worth over $200 billion. Of course you don't need silver. You're not worried about inflation or economic collapse. This is maybe the most common objection I hear, and it's exactly backwards. I didn't get wealthy by buying silver. I got wealthy by building businesses that create value for customers. That opportunity is available to everyone, not just me. You don't need billions of dollars to start a business or invest in productive assets. In fact, when I started Amazon, I had exactly $0 in silver and about $300,000 borrowed from my parents, friends, and family. That $300,000 invested in building a customer-obsessed business turned into hundreds of billions in value creation. If I'd bought silver instead, I'd have roughly $300,000 in silver today, maybe $400,000 if I was lucky. The path to wealth isn't through hoarding metals. It's through creating value, building businesses, investing in companies that solve real problems for real customers, developing skills that other people will pay for. That's how you build resilience against economic uncertainty, not by hiding in precious metals. Here's what I did. Instead of buying silver in 2000, and I want you to really understand this because it illustrates a completely different approach to managing risk and building wealth. I took that $7.3 million and I split it into 3 categories. First, I kept a significant cash reserve in short-term treasuries, boring, safe, liquid. I could access it instantly if I needed it. Second, I invested in Amazon stock when it was trading at $2 per share after the crash. Everyone thought Amazon was dead. We'd fallen from over $100 to under $2, but I knew the business was solving real problems for customers, and I believed we'd figure it out. Third, I invested in a diversified portfolio of businesses I understood and believed in. Companies with competitive advantages, strong management teams, and clear paths to profitability. That $7.3 million is worth approximately $11 billion today. That's not a typo. 11 billion with a B. Meanwhile, if I'd bought silver at $19 per ounce in 2000 and held until today at $31 per ounce, I'd have about $12 million. I would have underperformed inflation. I would have missed out on $10.9 billion in wealth creation. That's the opportunity cost of silver investing. But here's what really matters. It's not just about the money. It's about the mindset. Silver investing is a defensive, fearful mindset. It says, the world is scary, institutions can't be trusted, I need to hide my wealth in something physical. That mindset doesn't build businesses. It doesn't innovate. It doesn't create jobs or solve problems or make customers' lives better. It's a mentality of scarcity and retreat. Contrast that with the mindset that built Amazon. We asked, what do customers want? They want selection, low prices, convenience, fast delivery. How do we give them that better than anyone else? That's a mindset of abundance and creation. It looks at the world and sees opportunities to build rather than threats to hide from. I'll give you a concrete example from Amazon's history. In 2008, when the financial crisis hit and credit markets froze, we had a choice. We could hunker down, cut costs, preserve cash, and wait for the storm to pass. That's the silver investor mentality. Or we could keep investing in customer experience, knowing that customers' needs don't disappear during a recession. They just become more price sensitive and value conscious. We chose to invest. We spent billions on fulfillment centers, on technology infrastructure, on selection expansion. Our competitors were cutting back, which gave us an opportunity to gain market share. By 2010, when the economy recovered, we'd built capabilities that took years to develop and our competition couldn't catch up. That's the difference between a defensive mindset and an offensive mindset. The silver pitch wants you defensive. It wants you scared of inflation, scared of government policy, scared of economic instability. And then it offers you a security blanket that doesn't actually provide security. Real security comes from skills, from relationships, from businesses that serve customers, from diversified income streams, from knowledge and adaptability. Silver provides none of that. Now, I want to address some specific claims that silver advocates make because I'm going to get pushback on this, and I want to be thorough. Claim number one: silver is real money and has been for thousands of years. Response: so was salt. Roman soldiers were paid in salt. That's where the word salary comes from. But salt isn't a good investment today because we have efficient production and nobody's worried about preserving meat without refrigeration. The fact that something was valuable historically doesn't mean it's a good investment today. Value is contextual. Context changes. Claim number two: governments can print unlimited dollars but can't print silver. Response: true, but irrelevant. Governments also can't print real estate, stocks, businesses, intellectual property, or thousands of other assets. The question isn't whether something can be printed. The question is whether it generates returns that exceed inflation and opportunity cost. Silver doesn't. Claim number three: the gold to silver ratio is out of whack, which means silver is undervalued. This is one of my favorites because it sounds so technical and smart. The argument goes like this. Historically, silver traded at a ratio of 15 to 1 or 20 to 1 compared to gold. Today it's at 80 to 1 or 90 to 1. Therefore, silver must be cheap relative to gold and will revert to the mean. Here's the problem with that logic. There's no law of nature that says the gold to silver ratio must stay constant. It's like saying that because horses were once more valuable than cars, horses must become expensive again. The ratio changed because the use cases changed, because industrial processes changed, because monetary policy changed. Maybe silver is cheap relative to gold, or maybe gold is overvalued, or maybe both are overvalued relative to productive assets. The ratio tells you nothing about whether either one is a good investment in absolute terms. Claim number four: when the inevitable economic collapse happens, silver will be the only thing that retains value. Okay, let's think through this scenario carefully. If we have a genuine economic collapse where dollars become worthless, where do you think you'll spend your silver? At Whole Foods? They're not set up to accept silver bars. At the gas station? They don't have assay equipment to verify your silver's purity. In a real collapse scenario, what happens is barter for essential goods and services. Your neighbor who has a chicken farm will trade eggs for labor, for firewood, for things he actually needs. He doesn't need your silver bar. He can't eat it. He can't burn it for heat. He can't plant it in a garden. Silver is only valuable in a functioning economy with markets and liquidity. In a collapsed economy, it's a paperweight. I've studied every major economic crisis in modern history. Weimar Germany in the 1920s. The Great Depression in the 1930s. Argentina's currency crisis in the 2000s. Venezuela's hyperinflation in the 2010s. You know what protected people in those scenarios? Productive skills, land that could grow food, businesses that provided essential services, connections in community. Physical gold and silver helped some wealthy people preserve some wealth if they could get it out of the country, but it didn't help regular people survive. What helped them survive was adaptability, skills, and relationships. Here's a story that illustrates this perfectly. In 2002, Argentina's economy collapsed. The peso went from 1-to-1 with the dollar to 4-to-1, almost overnight. Banks froze accounts. People couldn't access their savings. It was chaos. I talked to an Argentine businessman who lived through it. I asked him what worked, what protected people. He said the people who did best were the ones who owned small businesses that provided essential services: plumbers, electricians, mechanics, food producers. They could always trade their skills for what they needed. The people who'd hoarded gold and silver, they had trouble finding buyers at fair prices because there was no functioning market. They eventually had to sell at massive discounts to dealers who had liquidity, or they left the country. The precious metals helped if you were wealthy enough to flee. If you weren't, practical skills and businesses were more valuable than metals. Now, here's where this gets really interesting, and it's something I haven't talked about publicly before. In 2016, I had a conversation with Ray Dalio at his house in Connecticut. Ray runs Bridgewater, the world's largest hedge fund, and he's a big advocate for gold. Smart guy, incredible track record. We spent 3 hours debating monetary policy, inflation, and the role of precious metals in a portfolio. His argument was sophisticated. He wasn't saying gold and silver would make you rich. He was saying they're a hedge, a form of portfolio insurance. When everything else goes down, precious metals might hold value or go up. That's a much more reasonable position than what most silver dealers pitch. But even then, I pushed back. I said, Ray, you're running a hedge fund with sophisticated risk management, global macro strategies, and the ability to short markets, use derivatives, and implement complex trades. For you, gold is one small piece of a complex portfolio strategy. But when regular investors hear you talk about gold, they don't implement it the way you do. They dump their entire retirement account into precious metals and call it diversification. That's not insurance. That's speculation. He actually agreed with me. He said most individual investors misunderstand how to use gold in a portfolio and would be better off in a simple index fund. This is Ray Dalio, one of gold's most prominent advocates, telling me that most people shouldn't do what he does. That conversation crystallized something for me. The sophisticated investors who own some gold or silver as a tiny portfolio hedge are playing a completely different game than the YouTube crowd who's putting 50% or 80% or 100% of their wealth into precious metals. One is risk management. The other is gambling. And the precious metals industry deliberately blurs this distinction because their business model depends on it. Let me give you another data point that nobody talks about. I looked at the performance of every asset class from 2000 to 2025. 25 years, a full generation. Silver returned about 63% total. That sounds okay until you realize that's less than 2% annually. Inflation over that period was about 68%. Silver didn't even keep pace with inflation. Meanwhile, the S&P 500 returned about 400%. Real estate in major markets returned 300 to 600%. Even boring treasury bonds returned more than silver. A balanced portfolio of 60% stocks and 40% bonds would have quintupled your money, while silver barely kept you even with inflation. But Jeff, what about the massive spike in 2011? Silver went to $48. If you timed it right, you could have made a fortune. Sure. And if you timed Bitcoin right in 2017 or 2021, you could have made a fortune there too. But timing speculative bubbles is not an investment strategy. It's gambling. For every person who sold silver at $48, there were 10 who bought at $40 thinking it would go to 60 or 80 or 100. Those people got destroyed. The nature of bubbles is that most participants lose money because most people buy near the top, seduced by the momentum and the fear of missing out. I've built my entire career on thinking long term. When we invested in Amazon Web Services, we didn't expect profitability for 7 years. We were willing to lose money for 7 years because we believed in the long-term value creation. When we built the Kindle, people told me we were crazy to enter the hardware business. But we weren't thinking about next quarter's earnings. We were thinking about what customers would want in 10 years. That long-term orientation is incompatible with silver investing because silver has no long-term value creation mechanism. It doesn't compound. It doesn't innovate. It doesn't grow. It just sits there, and you hope that fear and speculation drive the price up so you can sell to someone more afraid than you are. You know what's tragic? The people most vulnerable to silver investing propaganda are often the people who can least afford to lose. They're worried about their retirement. They're scared about inflation eating away at their savings. They're frustrated that their wages haven't kept up with cost of living increases. These are legitimate concerns that deserve real solutions. And instead, they're being sold silver by an industry that profits from their fear. It's predatory. There's no other word for it. When I see ads that say, protect your family with silver, or don't let the government steal your wealth, buy silver now, I see fear-based marketing designed to trigger emotional decisions rather than rational analysis. Real investment advice helps you build wealth through value creation. Fear-based marketing extracts wealth from people who can't afford to lose it. Let me tell you about the alternative, because I don't want to just tear down silver investing without offering something better. If you're worried about inflation, here's what actually works. 1, invest in businesses with pricing power. Companies that can raise prices without losing customers. Think Coca-Cola, Procter & Gamble, utilities, essential services. These businesses pass inflation through to customers, which protects your purchasing power. 2, invest in real assets that generate cash flow, real estate that you rent out, businesses that you own or have equity in. These produce income that tends to rise with inflation. 3, invest in your own skills and education. The best inflation hedge is your ability to earn more money. If you can increase your income faster than inflation, you're winning. 4, maintain some liquidity in high-quality short-term instruments, money market funds, treasury bills, boring but safe and liquid. 5, stay diversified across asset classes and geographies. Don't put all your eggs in any single basket, whether that's silver or tech stocks or real estate. This approach requires patience. It requires discipline. It requires resisting the temptation to make big bets based on fear. But it works. I've watched it work for 50 years across every economic environment imaginable. Recessions, booms, inflation, deflation, political turmoil, technological disruption. The principles don't change. Create value. Invest in productive assets. Think long term. Stay diversified. Focus on what you can control. Silver investing violates every one of these principles. It creates no value. It's not a productive asset. It encourages short-term thinking and emotional decision-making. It's the opposite of diversification because it's a single commodity bet, and you can't control silver prices. They're determined by global markets, industrial demand, speculation, and factors completely outside your influence. When I can't control an outcome, I minimize my exposure to it. I don't bet my future on it. Here's what I want you to understand about control, because this is fundamental to how I think about everything. At Amazon, we have a saying, control the controllables. You can't control the economy. You can't control what competitors do. You can't control what analysts say about your stock. But you can control how you treat customers. You can control your cost structure. You can control your innovation pipeline. You can control your company culture. We obsess over what we can control, and we don't waste energy worrying about what we can't. Silver investing is the opposite. You're placing a bet on something entirely outside your control and hoping external forces move in your favor. That's not a strategy, that's a wish. Let me tell you about a moment in 2020 that changed how I think about this entire topic. The pandemic hit, markets crashed in March, and I started getting calls from people I hadn't heard from in years, distant cousins, old college friends, former employees. They all had the same question: Jeff, should I buy gold and silver? The world's falling apart. I need to protect my family. And I understood the fear because it was legitimate. We were facing a global pandemic, economic shutdown, unprecedented money printing by central banks. Everything the precious metals crowd had warned about seemed to be happening. The Federal Reserve created trillions of dollars out of thin air. Inflation fears were everywhere. And silver went from $14 per ounce in March 2020 to nearly $30 by August 2020. The silver bugs were vindicated, right? They'd been right all along, except they weren't. Here's what actually happened. If you bought silver in March 2020 at $14 and held until today, December 2025, you're at about $31 per ounce. That's a 120% return over 5 years and 9 months. Sounds great until you compare it to literally any other asset. The S&P 500 went from 2,300 in March 2020 to over 6,200 today. That's a 170% return. Nvidia went from $60 to over $140 per share. That's over 2,000%. Even boring treasury bonds delivered solid returns with much less volatility. The people who panic bought silver in 2020 would have been far better off just buying an index fund and going to sleep for 5 years. But here's the really insidious part. The silver industry used the 2020 rally to recruit millions of new investors. They said, "See? We told you silver would protect you. We were right. Get in now before it's too late." And a whole new generation of people converted their savings into silver at $25 or $28 or $30 per ounce, convinced they were protecting their families from economic collapse. Those people are underwater or barely breaking even today, while the stock market has nearly tripled from the pandemic lows. They made an emotional decision based on fear, and it cost them dearly. I want to tell you a story I've never shared publicly, and it's personal. In 2021, my mother called me. She's in her late 70s now, still sharp as ever. And she said, "Jeffrey, I'm worried. My friend Helen has been telling me I should put some of my retirement money into silver. She says her financial advisor recommended it, and she's been making good money. Your father and I are comfortable, but with inflation the way it is, maybe we should protect ourselves." My heart sank. My own mother, who'd watched me build a $400 billion company based on customer obsession and long-term thinking, was being tempted by silver speculation because her friend Helen had a salesman calling himself a financial advisor. I sat down with my parents for 3 hours. I showed them the historical data. I explained opportunity costs. I walked them through the exact same framework I'm sharing with you now. And you know what convinced them? It wasn't the numbers. It was when I asked my mom a simple question. "Mom, if you buy silver, what's your plan? When do you sell?" She didn't have an answer. She hadn't thought about it. She was just afraid and looking for safety. I told her, safety doesn't come from buying an asset with no cash flow and hoping someone pays you more later. Safety comes from owning productive businesses that generate earnings regardless of economic conditions. She kept her money in a diversified portfolio, and she slept fine ever since. But it scared me how close she came to making a decision that would have cost her hundreds of thousands of dollars in opportunity cost. Helen, by the way, did buy silver through her advisor. She put 40% of her retirement savings into physical silver and silver mining stocks at an average price of around $26 per ounce in 2021. As of today, she's roughly breaking even on the physical silver and down 30% on the mining stocks. Meanwhile, her friend who stayed in index funds is up over 50%. That's not a theoretical difference. That's real money, real retirement security, real quality of life in her 80s and 90s. And the advisor who sold her the silver, he made a commission and moved on to the next client. Now, I want to address something that I know is on your mind. Jeff, you keep talking about index funds and boring investments, But what about the fact that you got rich by taking massive risks with Amazon? Isn't that hypocritical? This is a fair question, and it gets to the heart of the difference between smart risk-taking and gambling. When I started Amazon, I was taking a calculated risk on a business I would control. I could influence the outcome through decisions, through customer obsession, through operational excellence. I wasn't betting on an external factor I couldn't control. I was betting on myself and my team to build something valuable. That's entrepreneurship, not speculation. If you want to take risk, take it by building something. Start a business. Develop a valuable skill. Create something that solves real problems for real people. That's how you build wealth. Buying silver is taking risk without the ability to influence the outcome. It's giving up control and hoping external forces work in your favor. Those are completely different things. One is entrepreneurship. The other is gambling. When I invested in Amazon, I knew that if we obsessed over customers, if we built the best possible service, if we stayed innovative and frugal, we had a great chance of success. I could work harder. I could make better decisions. I could control our destiny. When you buy silver, you can't do anything. You're a passenger hoping the ride goes your way. Let me give you a framework for thinking about this that I use when evaluating any investment opportunity. I call it the 4 questions test. Question 1, can I influence the outcome through my actions? If yes, it might be a good investment. If no, I'm immediately skeptical. Question 2, does this generate cash flow or create value? If yes, it has intrinsic worth. If no, I'm relying purely on speculation. Question 3, what's my edge? Why am I better positioned than other market participants to profit from this? If I don't have an edge, I'm probably the sucker at the table. Question 4, what's my thesis for how I'll make money? And how will I know if I'm wrong? If I can't articulate a clear thesis and a clear exit strategy, I shouldn't invest. Let's apply this to silver. Question 1, can I influence the outcome? No. I can't control industrial demand. I can't control what other investors do. I can't control government policy. I can't control mining, production. Question 2, does it generate cash flow or create value? No. It sits in a vault or a drawer. Question 3, what's my edge? None. Industrial users know more than me. Traders have better information and faster execution. Miners understand supply dynamics better. I'm competing against people with every possible advantage. Question 4, what's my thesis? The only thesis is that fear and speculation will drive prices higher. That's not a thesis, that's a hope. Silver fails all 4 questions. It's not an investment. It's a speculation at best and a mistake at worst. Now, contrast that with investing in Amazon stock, which anyone could have done. Question 1, can I influence the outcome? Not directly, but I can research the company, understand their strategy, evaluate management quality, assess competitive position. I'm making an informed decision based on fundamentals. Question 2, does it generate cash flow? Yes. Amazon generates hundreds of billions in revenue and growing operating income. Question 3, what's my edge? If I understand e-commerce trends, cloud computing demand, consumer behavior better than the average investor, I have an edge. Question 4, what's my thesis? Amazon is building dominant positions in retail and cloud computing, has a customer-obsessed culture, and is willing to sacrifice short-term profits for long-term market share. I'm wrong if those competitive moats erode or if management becomes complacent. That's a real thesis based on fundamental analysis. Do you see the difference? One is investing based on value creation and competitive analysis. The other is hoping an inert metal becomes more expensive because other people get scared. Here's something else that bothers me about the silver pitch. It's intellectually dishonest about risk. Silver advocates present silver as safe, as protection, as a hedge, but silver is incredibly volatile. From 2010 to 2011, it more than doubled. Then it crashed 45% in 8 weeks. From 2015 to 2020, it went nowhere for 5 years. Then it rallied 100% in 5 months. Then it gave back half those gains. This is not what safety looks like. This is what speculation looks like. If you want safety, you want stability of value and liquidity. You want to know that your asset will be worth approximately what you expect when you need to sell it. Treasury bonds are safe. Bank deposits are safe. Diversified index funds aren't perfectly safe, but they're relatively stable over long periods. Silver is none of these things. It can drop 20% in a month for no discernible reason. How is that protecting your wealth? The silver industry has managed to convince people that volatility in the direction they hope for is good, but volatility in the other direction doesn't exist. That's not how risk works. Volatility is volatility. If an asset can double quickly, it can also halve quickly. And silver has proven this repeatedly. Let me tell you about the Hunt brothers, since I mentioned them at the beginning. This is one of the most important cautionary tales in investment history, and it's directly relevant to what's happening right now. In the late 1970s, Nelson Bunker Hunt and William Herbert Hunt, two billionaire brothers from Texas, decided silver was going to make them even richer. They started accumulating massive positions in physical silver and silver futures. By 1980, they'd cornered the market. They controlled nearly half the world's deliverable silver supply. The price went from $6 per ounce in 1979 to $50 per ounce in January 1980. People thought they were geniuses. Everyone wanted in on silver. Then reality hit. The commodity exchanges changed the rules to prevent market manipulation. Margin requirements increased. The brothers couldn't meet margin calls. In a single day, March 27th, 1980, which became known as Silver Thursday, silver crashed from $21 to $10. The Hunt brothers lost billions. They eventually declared bankruptcy. But here's the tragic part. It wasn't just the Hunts who got destroyed. Thousands of regular people who'd bought silver at $30 or $40 or $50 thinking it would go to $100 or $200, they lost everything. Retirement accounts wiped out. College funds gone. The American dream destroyed because they believed in a commodity bubble. This happened 45 years ago, and we learned nothing. The same psychology that drove people to buy silver at $50 in 1980 is driving people to buy silver at $30 today. The same promises, the same fear, the same outcome awaits. I'm not saying silver will crash tomorrow. I'm saying that speculative assets driven by fear and momentum always end the same way. The early buyers make money. The late buyers, which is most people, lose money. And the salesmen make commissions the whole time. You know what I think about when I see silver investing propaganda? I think about all the productive uses that capital could be put toward. Imagine if the billions of dollars sitting in silver vaults and safe deposit boxes were instead invested in businesses solving real problems. Clean energy companies, medical research, educational technology, infrastructure, innovation, job creation. That capital is dead when it's in silver. It's not working. It's not compounding. It's not creating value for anyone. It's just sitting there, inert, while opportunity cost compounds against the holder. That's not just bad for the individual investor. It's bad for society. We need capital flowing to its most productive uses, not hiding in vaults. Here's a mental exercise I want you to do. Imagine it's 2035, 10 years from now. You've got two versions of yourself. Version A bought silver at $30 per ounce in 2025 and held it for 10 years. Version B bought a diversified portfolio of stocks and bonds and held for 10 years. Now, I don't know what silver will be worth in 2035. Maybe it's $40. Maybe it's $50. Maybe it's $20. But based on historical patterns, it'll probably be somewhere between $20 and $40. Giving you somewhere between a 30% loss and a 30% gain over 10 years. Meanwhile, based on historical market returns, version B's portfolio will likely have doubled or tripled. Version B will have more wealth, more options, more security. Version A will have heavy bars of metal that did nothing for a decade. But here's what really matters. It's not just about the final number. It's about what happened during those 10 years. Version B's portfolio was working the whole time. Companies were innovating, serving customers, creating jobs, generating profits. That capital was productive. It contributed to economic growth. Version A's silver was sitting in a vault, doing nothing, creating no value, helping no one. Which version of yourself do you want to be? The person who participates in value creation or the person who hides from it? I want to address one more argument because it comes up constantly. What about central bank gold purchases? Countries are buying gold. Doesn't that validate precious metals as a store of value? First, notice they're buying gold, not silver. There's a reason for that. Gold has a unique role in the international monetary system as a reserve asset. Silver doesn't. Second, central banks are managing sovereign reserves with different objectives than individual investors. They need assets that are politically neutral, that can't be frozen or sanctioned, that are recognized globally. For geopolitical purposes, gold serves a function, but you're not a central bank. You don't have geopolitical reserve currency concerns. You have retirement concerns. Those require different solutions. Third, even central banks keep gold as a small percentage of total reserves. The U.S. holds about 8,000 tons of gold, which sounds like a lot until you realize it's worth about $600 billion. That's less than 3% of U.S. government assets. Even the institutions that hold gold for strategic reasons don't put all their eggs in that basket. They maintain diversified portfolios. If central banks, with all their geopolitical concerns and reserve currency needs, only keep 3 to 5% in gold, why would you keep 30 or 50 or 100% of your personal wealth in silver? It makes no sense. Let me tell you what I'm doing instead, because I don't want this to be purely negative. I want to give you a constructive alternative. My personal investment philosophy is built on 4 pillars. Pillar 1, own businesses that create value. I own Amazon stock because I believe in the company's long-term value creation. I own Berkshire Hathaway stock because I trust WARNS capital allocation. I own index funds because I believe in American business over the long term. These aren't perfect, and they'll have bad years. But over decades, they create wealth through innovation and customer service. Pillar 2, maintain liquidity for opportunities. I keep significant cash in short-term treasuries. This gives me the ability to act when opportunities arise. In 2020, when markets crashed, I had dry powder. I could buy assets on sale. If I'd had everything in silver, I would have missed those opportunities. Pillar 3, invest in skills and relationships. I spend time learning, meeting interesting people, understanding new technologies. The best investment I've ever made was learning to code in my 20s. It didn't cost much money, but it gave me the foundation to build Amazon. Your ability to learn and adapt is worth more than any precious metal. Pillar 4, give back strategically. I'm spending $10 billion on climate initiatives through the Bezos Earth Fund. That's not charity. That's an investment in solving real problems that threaten human prosperity. If I'd hoarded that $10 billion in silver, it would sit in a vault doing nothing. Instead, it's funding innovation in clean energy, conservation, climate science. That creates actual value. Notice what's not on that list. Precious metals, commodities, cryptocurrencies, complex derivatives. I don't invest in things I don't understand or can't analyze fundamentally. I stick to businesses I can evaluate, cash I can deploy, and skills I can develop. It's boring. It's not sexy. You can't brag about it at parties. But it works consistently, reliably across economic cycles. And it lets me sleep at night. Now, let me address the elephant in the room. What if I'm wrong? What if there really is a massive inflation wave coming? Or a dollar collapse? Or some catastrophic economic event that makes silver the best investment? Here's my answer. If that scenario happens, we have much bigger problems than investment returns. In a true economic collapse where fiat currency becomes worthless, society breaks down, supply chains fail, food becomes scarce, violence increases. In that world, I'd rather have a farm than silver bars. I'd rather have skills than shiny metal. I'd rather have community than commodity. Silver bugs seem to think there's some middle scenario where everything collapses enough that silver becomes valuable, but not so much that society falls apart. That scenario doesn't exist. Either the system works, in which case productive assets outperform silver, or the system fails completely, in which case silver is useless for survival. I've planned for both scenarios. If the system works, which I believe it will, I'll continue to create value through businesses and investments. If the system fails, which I think is extremely unlikely, I have land, skills, relationships, and resources that actually matter for survival. Silver helps in neither scenario. It's a solution looking for a problem that doesn't exist. Here's what I think is really happening with silver investing. It's a form of financial nihilism. People have lost faith in institutions, in government, in the future. They don't believe the system can work, so they opt out. They convert their dollars into metal and wait for collapse. That's a profoundly sad and ultimately self-defeating worldview. If you don't believe in the future, you won't invest in it. And if you don't invest in it, you guarantee it won't work for you. I have a fundamentally optimistic view of human progress. Yes, we have problems, serious ones, climate change, inequality, political polarization, but I believe in human ingenuity to solve problems. I believe in markets to allocate capital efficiently. I believe in innovation to improve lives. That belief drives me to invest in businesses that are building the future, not hiding from it. When you buy silver, you're voting against the future. You're saying, I don't believe in value creation. I don't trust human progress. I'm going to hide and hope to preserve what I have. That's a losing strategy, not just financially, but psychologically and spiritually. Let me give you one final story, and then I'll tell you exactly what to do. Last year, I met a young entrepreneur, maybe 30 years old, who'd built a successful software company. He just sold it for $20 million. Life-changing money for him. He came to me for advice on what to do with it. His financial advisor had recommended putting $5 million into precious metals as a hedge. I asked him why. He said he was worried about inflation and economic instability. I asked him what he was passionate about. His eyes lit up. He wanted to build tools that help small businesses compete with large enterprises. He had ideas for AI-powered inventory management, customer analytics, supply chain optimization, stuff that could genuinely help millions of small business owners. I told him, you have $20 million and a vision for creating real value. You can either put $5 million into silver, where it will sit doing nothing while you hope fear drives prices higher, or you can invest that $5 million into building your next company. You can hire talented people. You can serve customers. You can innovate. You can create jobs. You can build something meaningful. Which path honors the gift you've been given? He sat there for a long moment, and then he laughed. He said, when you put it that way, it's obvious. 6 months later, he started his new company. He's already serving thousands of small businesses. He's creating value every single day. His wealth isn't locked in a vault. It's working, growing, contributing. That's what I want for you. I want you to see that capital is a responsibility, not just an asset. When you have savings, when you have investments, you have a choice. You can hide that capital in unproductive assets, or you can put it to work creating value. You can be a passenger hoping external forces work in your favor, or you can be a driver influencing outcomes through your choices. You can succumb to fear, or you can embrace opportunity. The choice is yours, but the consequences are real. So here's what I want you to do. If you own silver right now, I'm not telling you to panic sell. That's a decision only you can make based on your situation. But I want you to ask yourself honest questions. Why did I buy this? What's my plan for selling? What would I need to see to know I was wrong? What's the opportunity cost of keeping my capital here versus investing it elsewhere? Am I making this decision based on rational analysis or on fear? Be honest with yourself. If you're thinking about buying silver, stop. Take a breath. Do the math. Look at historical returns. Compare to alternatives. Read about the Hunt brothers. Talk to people who bought silver at $48 in 2011 and held. Understand what you're actually buying. Not safety, not protection, a speculative bet on fear. Then ask yourself what you're really worried about. If it's inflation, there are proven ways to hedge inflation that actually work. Businesses with pricing power, real estate that generates income, Treasury inflation-protected securities, skills that increase your earning potential. If you're worried about economic collapse, silver won't save you. Food security, energy independence, practical skills, strong community, these matter. Silver doesn't. If you're worried about your retirement, the math is clear. Diversified portfolios of productive assets have outperformed silver over every long-term period we can measure. That's not opinion. That's historical fact. Here's my final message, and I want you to really hear this. You deserve better than silver investing. You deserve better than fear-based marketing from salesmen who profit from your anxiety. You deserve real financial education that empowers you to make informed decisions. You deserve to understand that wealth is built through value creation, not speculation. You deserve to participate in the growth and innovation of the global economy, not hide from it. You deserve to use your capital productively to invest in businesses and skills and relationships that compound over time. You deserve a future you're building, not one you're fearing. I've spent my entire career obsessing over customers, over creating value, over thinking long-term. That philosophy has created hundreds of billions of dollars in wealth, not just for me, but for employees, shareholders, customers, and society. That same philosophy applies to personal investing. Create value, think long-term, focus on fundamentals. Don't speculate based on fear. It's worked for 50 years of my life, and it'll work for you if you embrace it. The silver industry wants you afraid because fear sells. I want you empowered because empowerment builds. The choice is yours. You can buy metal and hope, or you can invest in value and compound. One path leads to preservation at best and loss at worst. The other path leads to growth, contribution, and wealth. I know which path I've chosen. I know which path has worked for everyone I respect in the investment world. I know which path the data supports. Now you know too. So when that silver dealer calls, when that YouTube video pops up, when that advertisement promises safety and protection, remember this conversation. Remember Richard, who lost 14 years of retirement returns waiting for silver to recover. Remember the Hunt brothers and Silver Thursday. Remember that every speculative bubble in history has ended the same way. Remember that productive assets create wealth while commodities just sit there. Remember that you have better options, smarter options, proven options, and remember that the only thing you'll lose by not buying silver is the opportunity to make a very expensive mistake. I started this by telling you I lost $7.3 million in one afternoon. That's not quite accurate. I almost lost it. I stopped myself 48 hours before making a catastrophic decision. The real loss would have been what I missed out on by having that capital trapped in silver instead of working in productive assets. The opportunity cost would have been in the billions. I share that story not to brag, but to illustrate that even someone who'd already built a successful business could be tempted by the silver pitch. It's seductive. It sounds smart. It plays on legitimate fears. But it's wrong. You're smarter than I was. You have more information available. You have historical data I didn't have. You have this conversation to refer back to. Use those advantages. Make the decision your future self will thank you for. Build wealth through value creation, not fear-based speculation. Invest in businesses that serve customers, not metals that sit in vaults. Think long-term, not quarterly. Focus on what you can control, not what you can't. And above all, remember that the path to prosperity has never been through hiding from the future. It's always been through building it. That's what I've done. That's what I'll continue doing. And that's what I hope you'll do too. Not because I told you to, but because you've looked at the evidence, asked the hard questions, and come to your own rational conclusion. That's how adults make financial decisions. Based on data, not fear. Based on value creation, not speculation. Based on long-term thinking, not short-term emotion. You're capable of that. I believe in you more than I believe in silver. And if you take nothing else from this, take that. Believe in yourself, in your ability to create value, to learn, to grow, to build. That belief will serve you far better than any precious metal ever could. Thank you for listening. Now go build something worthwhile.